Hi, welcome. You're watching BQ Prime. I'm Tamanna Inamdar, and as results season is kicking off, today we're talking about Metro Brands, whose numbers came in yesterday. A pure play footwear retailer. The stock has been performing pretty decently this morning. Let me just quickly go through the results before we start speaking with the CEO of the company to get an idea of their outlook for the next quarter and this previous one as well. So year on year in Q2, revenue was up 17% at 555 crores versus 476 crores. This was largely in line with expectations. EBITDA was up 5.4% at 156 crores. Margins, though, did get squeezed to some extent at 28% versus 30.89%, and net profit was down for the period, down from 13.1818% at 68 crores versus 78 crores. We saw a bit of that margin squeeze, especially coming in Q on Q as well. Now, let me get into the conversation. Mr. Joseph is with us today, Nissan Joseph, his CEO of Metro Brands. Mr. Joseph, great to speak with you on the show. Welcome.
Good morning, Tamanna, and thank you for having me.
All right, let's start with the numbers in Q2. Can you elaborate on that drop in net profit and margins quarter on quarter and year on year?
Sure. I think what's important is that we look at the business as a standalone business. As you know, Metro Brands has a couple of subsidiaries, one of them being Fila, and the recent Fila acquisition we did. So we know that Fila for this coming year is going to be dilutive to our earnings. I think so to understand the health of the business, it's important to look at it solely from a standalone perspective. And in that standalone perspective, you know, our sales were up 15%, and we had a 15% profit, and our profits were up, our PAT was up 7%. So, you know, while it looks like on a consolidated basis, the PAT came down, on a standalone basis, Metro continued to increase their profits for the quarter. And you know, I think that's important, especially last quarter, because it was a tough quarter. We had a couple of timing headwinds, Tamanna. It's not economic headwinds, but timing headwinds. So the three things we had going against us was, one, we were going against pent-up demand from last year. You know, last year people were just coming out of COVID and they were celebrating with shopping, right, so to speak. The second thing is, you know, we had a lot of festivals that are delayed by about 2.5 to 3 weeks this year, pushing them into the third quarter when they were pretty active in the second quarter last year, right? So that's another headwind that we had to overcome. And then the wedding season, we've seen the wedding season date shift into Q3 as well. You know, there's 32 lakh weddings supposed to be scheduled between late November to early December. All those three things were headwinds to our business in Q2. And despite that, we not only had a sales increase, but we also had a profit increase. So it's very encouraging for us to see that kind of performance rigor that Metro Brands has through it all.
So your headwinds in Q2 will likely turn into your tailwinds in Q3. Give us a sense, Mr. Joseph, on the contribution to revenues that these events have, these cyclic annual events, the festive season and wedding season.
Yeah. So, you know, in our business, Q3, which has a lot of these festivals, right, tends to be the largest quarter for us, running about 27% of the year on an average. Q4 and Q2 have the EOS impact, right? And Q2 is really our lowest quarter, running at about 23% of the year, right? So you can see that has a significant jump, about a 10 to 15% increase in just that one quarter, and it's largely driven by those festivals, which are predominantly in the third quarter. So we see a huge uptick in business when it comes to festivals. It also coincides with, you know, people wanting to take winter breaks and holidays and so on and so forth, and travel internationally as well. So we firmly watch the festival season very closely, and despite the fact that we were going against it, you know, the early read that we're getting into markets that are now going into their festival period, such as the Durga Puja festival and also the Dasara festival, is that we're seeing that these are not economic headwinds that we were facing, they were only timing headwinds that we were facing.
Are you seeing that sort of consumer excitement, as you're describing it, ahead of festive season evenly spread? Or is there a higher concentration in urban and semi-urban areas? There's a lot of talk on the impact of patchy monsoons this year, rural demand still being a little dampened. Are you seeing all of that play out? What are your expectations there?
The biggest influence on our business that we've seen that has shifted it has been the timing of the festivals, and we've not seen it from a erosion or an increase in sales in any one of our tiers of operation, right? So the ratio of contribution that we get from the tier 3 and tier 2 cities relative to our dispersion in them continues to remain relatively constant. So we're not seeing that as a driver. We see more of the festival shift. We do sell a premium product, right? Our sales of products over 3,000 rupees hit 48% last quarter. This was compared to 44% the quarter before. So the premium consumer continues to exist in all tiers of Indian markets. And they have not been shying away from making sure that they can get their products at Metro.
What is that ratio that you were mentioning of rural demand or rural and tier 2, tier 3 cities?
Well, tier 2, tier 3 cities are roughly right at about 20-25% of our business. But when you look at our dispersion of stores, that runs about the same number as well. So we're not seeing any significant shift in the way our demographic change is coming due to any slowdown in consumption in tier 2 and tier 3 cities.
Okay, so you're not seeing any slowdown in consumption. That's a good point. We started off talking about the numbers in Q2. You talked about the FILA impact or the FILA effect on your consolidated numbers. How long do you expect that to play out? Do you see that playing out for all of FY24?
Right, so, we've been in business for 70 years as a company, and we intend to be in business another 70 years. So we look at everything from a long-term perspective, right? And we see immense opportunity for the FILA brand in India. We think the brand has tremendous relevance in the Indian market, tremendous awareness in the Indian market, and more importantly, as the Indian consumer continues to get more health conscious and also more fashion conscious, FILA, I think, plays to that very, very well. Having said that, we need to reposition the brand. And the first thing you need to do before you can reposition a brand is we have to clean it up. So we are going to focus this year largely on cleaning up the brand, which also involves, rationalizing the stores, rationalizing the distribution that we're in currently, and also getting rid of inventory that we don't believe sets the brand up for the future. So broadly, we anticipate this year to be a cleanup year and for FILA to continue to be dilutive to our earnings for this year. Next year is going to be a reset year where we reset the brand as to where we want to take it to the future. And the third year is going to be an acceleration year. So when you look at it long term, when you look at it short term, you think, well, boy, 3 years is a long time. But it really isn't when you look at it for a brand that we have for multi-decades in the agreement, right? So we want to make sure that we position it right. And that's roughly the story about FILA and how we see that growing up. Each of those phases, phase 1, cleaning out the inventory, phase 2, resetting the brand, phase 3, accelerating the brand, takes a lot of work, takes a lot of investment in terms of time and headspace, right? So we're keen to do that because we believe in the future of FILA and FILA's potential in India.
The timeline for that, by the point you reach the accelerating the brand stage?
Yeah, so it will be in FY. So 24 is cleanup, 25 is reset, 26 the start of 26. So it'll be March of 25 that we start to accelerate the brand. Somewhere in the beginning of 25, basically, is where you start to see the acceleration of the brand.
Okay. Now, like you said, Mr. Joseph, and rightly so, this is a very well-known brand. It's a 70-year-old company. And you are right now retailing in times where online shopping is growing exponentially. Now, I see that your rate of online presence and sales has increased to about 11% this quarter from 8%. What is your outlook on that? Are you seeing your business model working as a predominantly brick and mortar retail store where people come in and size up, or are you seeing the growth in online shopping?
So I think for most brands, especially in the footwear space, right, DTC is very, very attractive, and DTC has become synonymous with e-commerce, and I don't think that's the case. We are a D2C brand. We go directly to the consumers with our brand. But when it comes to the e-com space, I think it has opportunities to get up to the teens in terms of a percentage of our business, not because there's not potential in e-commerce. There's immense potential in e-commerce, but the rest of our business is growing as well. And we were very pleasantly surprised when we came out of the pandemic to see that consumers not only gravitated right back to stores and physical shopping, but also continued to shop online. The big play, though, is as we move to the future, we believe that more and more of our customers, if not all of them at some point, will start their journey on a digital space. They'll start to look for products, they'll start to look for what they want at a digital space, and then they'll move to make their purchase decisions, sometimes online, sometimes offline. But we think it's going to be a key player to us, regardless of where they shop, to be digitally invested and alive.
So could you put some numbers to that, an outlook to that? Is there an internal goal on how much of your sales are going to be online going ahead?
Yeah, I think there's a healthy number there, right? Because, the consumer never totally experiences the brand online, right? So it's one of those things that you don't want to just be pushing them to online sales all the time. Good example is all the online players at some point you'll notice start to open brick and mortar, right? The brands, I mean, right?
True.
It's simply because consumers cannot engage with your brand as effectively online. You don't get the eyeballs for long enough, right? Online. So we think it's that e-commerce has a distinct role to play, and it's somewhere in the mid-teens is where it would be a good, healthy number for us to target. And that whether that happens in the next 2 to 5 years is a big question. Simply because, not because I don't think e-commerce can do it. I think it's because we control e-commerce. As you know, in India, e-commerce can be pretty discount-led, and that's not a game to get into because it tarnishes your brand. So if we wanted to, we could really push the accelerator and get it up to high double digits very quickly, but we don't want to play that game. We want to offer customers consistent value for the products, play to a premium consumer, and make sure that they have access to our products as well online. So I think a mid-teen in the next few years is definitely a realistic, but also a sensible target to achieve.
Let me wrap up with your outlook, not just on Q3, where you'll see the festive season, but H2, the second half of this financial year. What are we looking at in terms of stores? What are we looking at in terms of CapEx? And of course, the kind of revenues and profits that you hope to come in?
Sure. So we guided that we would open 100 stores this year. And we guided to open another 100 stores the following fiscal year, right? So we've already opened up 54 stores this year, putting us well on pace to hit the 100-store mark. As we deliver to our guidance, we will close out to FY25 with about roughly 950 stores, give or take. So that is roughly where you can expect Metro Brands to be, and I'm not including Fila in that number, by the way. So that's number one. Number two, we've always guided that we'll maintain our margins in the 55 to 57% range on an annualized basis. We don't see H2 being any different to that. We also guided that our EBITDA would be north of 30%, and our PAT would run between 15 and 17%. And we see no reason for H2 or the coming years to have a challenge to that guidance.
All right. Great to speak with you, Mr. Joseph. Thank you so much for joining us today.
Thank you. Have a great day.
You too.